Credits. Credits versus deductions. The advantage of credits is that they reduce tax liability on a dollar-for-dollar basis, whereas deductions only reduce income that is subject to tax. Therefore, credits are more valuable than deductions. Child and Dependent Care Credit. Taxpayers may be able to claim the Child and Dependent Care Credit if they paid expenses for the care of a qualifying individual that enabled them or a spouse, if filing a joint return, to work or actively look for work. Generally, this credit may not be claimed with a filing status of married filing separately. Total expenses that may be used to calculate the credit may not be more than $3,000 for one qualifying individual or $6,000 for two or more qualifying individuals. A qualifying individual for the Child and Dependent Care Credit is a dependent qualifying child who is under age 13 when the care was provided, or a spouse who is physically or mentally incapable of self-care and lived with the taxpayer for more than half the year, or a person who wasn't physically or mentally able to care for himself or herself, who lived with the taxpayer for more than half the year and either was their dependent or would have been their dependent except that he or she received gross income of $4,150 or more, he or she filed a joint return, or the taxpayer spouse, if filing jointly, could be claimed as a dependent on someone else's 2018 return. The amount of work-related expenses that can be used to figure the credit can't be more than earned income for the year if single at the end of the year, or the smaller of earned income or spouse's earned income for the year if married at the end of the year. To determine the amount of the credit, multiply work-related expenses after applying the earned income and dollar limits by a percentage from 20 to 35%. Child Tax Credit. The Tax Cut Job Act increased child tax credit from $1,000 to $2,000. Eligibility for the credit has not changed. As in past years, the credit applies if all these are applicable. The child is younger than 17 at the end of the tax year. The taxpayer claims the child as a dependent. The child lives with the taxpayer for at least 6 months of the year. The credit is refundable up to $1,400. If a taxpayer doesn't owe any tax before claiming the credit, they will receive up to $1,400 as part of their refund. The income threshold to claim the credit has been lowered to $2,500 per family. This means a family must earn a minimum of $2,500 to claim the credit. The income threshold at which the child tax credit begins to phase out is increased to $200,000 or $400,000 if married filing joint. This means that more families with children younger than 17 qualify for the larger credit. Dependents who can't be claimed for the child tax credit may still qualify the taxpayer for the credit for other dependents. This is a non-refundable credit up to $500 per qualifying person. These dependents may also be dependent children who are age 17 or older at the end of 2018. It also includes parents or other qualifying relatives supported by the taxpayer. So if the child tax credit doesn't work, there's always the other dependent credit that goes up to $500 on a non-refundable basis. Education credits. There are two education credits available: the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC. There are additional rules for each credit, but both credits have the following requirements. The taxpayer, their dependent, or a third party pays qualified education expenses for higher education. An eligible student must be enrolled at an eligible educational institution. And the eligible student is the taxpayer, their spouse, or a dependent listed on their tax return, or at least meeting the rules to be considered a dependent. Taxpayers cannot claim an education credit when someone else, such as parents, lists them as a dependent on their tax return, or again, at least that they are eligible to be considered a dependent on their parent's tax return. Filing status cannot be married filing separate. If they already claimed or deducted another higher education benefit using the same student or the same expenses, they cannot use that for the education credits. The taxpayer or spouse cannot be a non-resident alien for part of the year and could not have chosen to be treated as a resident alien for tax purposes. The American Opportunity Tax Credit is a credit for qualified education expenses paid for an eligible student for the first 4 years of higher education. They can get an annual credit up to $2,500 per eligible student. If the credit brings the amount of tax owed to zero, they can have 40% of any remaining amount refunded to them, up to $1,000. To be eligible for American Opportunity Tax Credit, the student must be pursuing a degree or other recognized education credential, be enrolled at least half-time for at least one academic period beginning in the tax year, and could not have finished the first 4 years of higher education at the beginning of the tax year. In other words, it's not really intended for graduate school. They could not have claimed the AOTC or formerly what was known as Hope Credit for more than 4 tax years. They could not have a felony drug conviction at the end of the year. The Lifetime Learning Credit, on the other hand, is for qualified tuition and related expenses paid for eligible students enrolled in an eligible educational institution. This credit can help pay for undergraduate, graduate, and professional degree courses, including courses to acquire or improve job skills. There is no limit on the number of years that the Lifetime Learning Credit can be claimed. It is worth up to $2,000 per return. So American Opportunity Credit limit, dollar limit, is on a per student basis. The Lifetime Learning Credit is on a per tax return basis. To claim a Lifetime Learning Credit, you must meet all 3 of the following: taxpayer, dependent, or third party paid qualified education expenses for higher education. Taxpayer, dependent, or third party pays the education expenses for an eligible student enrolled at an eligible educational institution. The eligible student needs to be taxpayer or spouse or a dependent listed on the return, or at least meet the rules to be considered a dependent. Foreign tax credit. Taxpayers can claim a credit for foreign taxes that are imposed on them by a foreign country or U.S. possession. Generally, only income, war profits, or excess profit taxes qualify for the credit. This can also be the amount of foreign taxes can also be taken as a deduction on Schedule A. In most cases, it's to the taxpayer's advantage to take as a tax credit. If the taxpayer excludes foreign income or foreign housing costs, they cannot take a foreign tax credit for taxes on income that they have excluded on their U.S. return. If they take the credit, one or both of the choices may be considered revoked. File Form 1116 to claim the foreign tax credit. Earned Income Credit. The Earned Income Tax Credit, or EITC, or just simply EIC, is a benefit for working people with low to moderate income. To qualify, taxpayers must meet certain requirements and file a tax return, even if they don't owe any tax or are not required to file. The Earned Income Tax Credit reduces the amount of tax owed and may give a refund. In other words, it's a refundable credit. To qualify for Earned Income Tax Credit, taxpayer must have earned income from working for someone or from running or owning a business or farm and meet basic rules. They must either meet additional rules for workers without a qualifying child or have a child that meets all the qualifying child rules. The maximum amount of the credit for tax year 2018 is $6,431 with 3 or more qualifying children, $5,716 with 2 qualifying children, $3,461 with 1 qualifying child, or $519 with no qualifying children. Retirement Savings Contribution Credit. Taxpayers may be able to take a tax credit for making eligible contributions to their IRA or employer-sponsored retirement plan. They're eligible for the Retirement Savings Contribution Credit if they're age 18 or older, not a full-time student, not claimed as a dependent on another person's return. The amount of the credit is either 50%, 20%, or 10% of contributions to a retirement plan or IRA or ABLE account. The maximum contribution amount that they may use to qualify for the credit is $2,000 or $4,000 if married filing joint. And those are the amounts that would be multiplied against their credit percentage. The maximum credit, therefore, is $1,000. Beginning in 2018, the Savers Credit can be taken for contributions to an ABLE account. Adoption Credit. Tax benefits for adoption include both a tax credit for qualified adoption expenses paid to adopt an eligible child and an exclusion from income for employer-provided adoption assistance. The credit is non-refundable, which means it's limited to the taxpayer's tax liability for the year. However, any credit in excess of tax liability may be carried forward up to 5 years. The maximum amount or dollar limit for 2018 is $13,810 per child. For both the credit and the exclusion, qualified adoption expenses include reasonable and necessary adoption fees, court costs and attorney's fees, traveling expenses, including that amount spent for meals and lodging while away from home, and other expenses that are directly related to and for the principal purpose of the legal adoption of an eligible child. The credit and exclusion are each subject to an income limitation and a dollar limitation. The income limit on the adoption credit is based on modified adjusted gross income. If modified adjusted gross income for 2018 falls between certain dollar limits, the credit is subject to a phase-out. Credit or exclusion is subject to a phase-out. For tax year 2018, the modified adjusted gross income phase-out begins at $207,140 and ends at $247,140. Thus, if modified adjusted gross income is below those amounts, the credit or exclusion won't be affected by modified adjusted gross income. Whereas if modified adjusted gross income is $247,140 or more, the credit or exclusion will be zero. Taxpayers must reduce the dollar amount for a particular year by the amount of qualified adoption expenses paid and claimed in previous years for the same adoption effort. Generally, the credit is allowable whether the adoption is domestic or foreign. However, the timing rules for claiming the credit for qualified adoption expenses differ depending on the type of adoption. A domestic adoption is the adoption of a U.S. child, an eligible child who is a citizen or resident of the U.S. or its possessions before the adoption effort begins. Qualified adoption expenses paid before the year the adoption becomes final are allowable as a credit for the tax year following the year of payment, even if the adoption is never finalized and even if an eligible child was never identified. On the other hand, a foreign adoption is the adoption of an eligible child who isn't yet a citizen or resident of the U.S. or its possessions before the adoption effort begins. Qualified adoption expenses paid before or during the year are allowable as a credit for the year when it becomes final. In other words, no credit for foreign adoption until the year the adoption becomes final, and only if the adoption becomes final. Just to clarify the income modifications, the phase-out of the credit begins at $207,140 and ends at $247,140. The ACA net premium tax credit. Taxpayers are eligible for the premium tax credit if they meet all of the following requirements. They have household income that falls within a certain range. To be eligible, their household income must be at least 100%, but not more than 400% of the federal poverty line for their family size. Although there are two exceptions for individuals with household income below 100% of applicable federal poverty line. Taxpayers do not file a tax return with married filing separate. There is also an exception to this rule that allows certain victims of domestic abuse and spousal abandonment to claim the credit even though they are married filing separately. It cannot be claimed as a dependent by another person. They must meet additional requirements in the same month for themselves or a family member. They need to have health insurance coverage through a health insurance marketplace. They are not able to get affordable coverage through an eligible employer-sponsored plan that provides minimum value. They are not eligible for coverage through a government program like Medicare, CHIP, or TRICARE. If they meet all of those requirements, they can be eligible for the ACA premium tax credit. Other credits. The health coverage tax credit is a refundable tax credit that pays 72.5% of qualified health insurance premiums for eligible individuals and their families. Taxpayers may elect to receive the credit through their federal tax return or through advanced monthly payments paid directly to their health plan administrator. They may be eligible to elect the credit only if they are one of the following: an eligible trade adjustment assistance recipient, an alternative trade adjustment assistance recipient, or a reemployment trade adjustment assistance recipient. An eligible pension benefit guarantee corporation payee, or the family member of one of those. Or a PBGC, Pension Benefit Guarantee Corp, payee who is deceased or who has finalized a divorce with the taxpayer. People are not eligible for the credit if they can be claimed as a dependent on another person's federal income tax return or are enrolled in Medicare, Medicaid, the Children's Health Insurance Program, or federal employee health benefit programs, or are eligible to receive benefits under the U.S. military health system, TRICARE. The general business credit for the year consists of a carry forward of business credits from prior years, plus the total of current year business credits in addition to the general business credit for the current year. This credit is subtracted directly from tax. Let's look at some questions. Which one of the following is not a qualifying person for purposes of the child and dependent care credit? So which of the following is not a qualified person? A spouse who is physically not able to care for himself or herself? Well, that's a qualifying person. A dependent who was age 12 when the care was provided and for whom the taxpayer can claim an exemption. Well, that's a qualifying person. A child who was under age 13 when the care was provided, but who lived with the former spouse all year. That is not a qualifying person. That child needs to live with the taxpayer. And then a dependent who is mentally not able to care for themselves or herself, and for whom an exemption can be claimed by the taxpayer. Well, that is a qualifying person. Mary files as head of household and has 3 dependent children, age 15, 16, 17. Mary and the children are U.S. citizens. Her only income is a salary of $77,500. Her tax is $13,262. How much child tax credit is she allowed? Well, the answer is $4,000 for the child tax credit specifically. Now, note that the 17-year-old would be eligible for the $500 other dependent credit, but they would not be eligible for the $2,000 child tax credit. Which of the following is not a test to determine if a child is a qualifying child for earned income tax credit? Relationship, that's a test. Age, that's a test. Residency, that's a test. Support is not a test for the earned income tax credit. Support is not a test for earned income tax credit. And then finally, Jane works at a retail store, married, earned $29,000 during the year. Her husband was unemployed, didn't have any earnings. Jane contributed $2,000 to her IRA. After deducting her IRA contribution, the adjusted gross income on their joint return is $27,000. Considering this information, how much can Jane claim for a retirement contribution credit? Well, first of all, we would use up to we would use the $2,000 that she had contributed to her IRA. And we would multiply that by a rate. Their adjusted gross income is $27,000. If we look on our chart, we see that a $2,000 contribution multiplied by the applicable rate, which is 0.5 or 50%, would yield us a $1,000 credit. A $1,000 credit. So that's our correct answer right there. Okay, well, thank you very much. I know a couple hiccups in the reading, but otherwise I hope you got a lot out of this video, and thank you for studying with us.